Much for joining us in today's webinar. Very, very happy to have Mohammed Nalla. For those of you that haven't met him, Mohammed is runs global macro research. He's a former head of Treasury and global market research at Nedbank and head of research at the Public Investment Corporation. So very, very pedigreed research analysts that we do have with us today. So it really is a pleasure having Mo. Thank you for joining us.
Thank you for having me.
Yeah, it's great. Just before I hand over to Mo, we do have some very, very good news. I'd just like to take 2 minutes of your time for everybody that's here. We know that most of our traders do enjoy trading indices. And just ahead of the US elections, which obviously is November the 5th, we are hoping to launch live US indices, the Nasdaq, the S&P, and the Dow, all labeled as the US Tech 100 or Wall Street and US 500. And you will be able to trade that from a locally funded account. We're in the final testing phases, so we're ironing out all the last little bugs. Really, really exciting product. We know most of our traders do like trading indices, and so they will be very competitively priced. We're looking at trading in rands. If you know all these products, 10 rand a point. If you're trading Wall Street, US 500, US Tech 100. It's got some good leverage. Remember, with leverage comes great responsibility. But your margin requirement will be 0.5% of your exposure. So really, really exciting products. Very competitive spreads. So your cost there will be even more competitive than the South Africa 40 index. So if you are an index trader, this is really something very, very exciting, and hopefully we can have it just in time for you. So we're doing our best to get that up and running, but it is coming. It is in the final testing phases, and as you can see, it is available on the platform. As you can see, available here. Oh, sorry, this is the test platform. So hopefully we're going to push it live to our clients. So if you're an existing IG client, something really, really cool to look forward to. All right, that's all from me. I'm going to hand over to Mo. Thank you very much for joining us, Mo. Looking forward to your insights.
Thank you so much, Sean. And I assume you're going to be driving the presentation from your side.
Yeah.
Just in terms of, I mean, obviously the usual disclaimers, I've got to put it out there, both from myself as well as from IG's perspective. I mean, nothing we say on the call today is to be deemed financial advice. We hope we're going to share some very exciting and interesting information with you. But again, take that away, digest that in terms of just how you use the information. Just in terms of some background, I mean, Sean's kind of indicated where I come from. And maybe just on the next slide, I've just given you some indication in terms of myself and macro tech research, which is my business that I co-founded with my partner, Piet Serfontein. Piet is a technical analyst that's been top-rated analyst in the FM rankings for several years. We had worked together at Nedbank many years ago, and Piet and I have kind of come together to found macro tech research, which focuses both on technical analysis, which is very relevant to traders, but then also on the macro side of things, which is really where my speciality comes through. And the reason why I guess I'm speaking to you today is I'm currently up in Canada, so I guess I'm a lot closer to some of the fireworks and the action that we're seeing in the US election season. It arguably, I mean, the impact of that is worldwide. It's going to impact you down in South Africa, certainly impacts me as a neighbor to the United States quite closely. And we're going to try and unpack what does the current US election season mean for investors, for traders in markets. Just in terms of a run through, in terms of the presentation, we've got a lot to get through, so I'm going to go fairly quickly. I believe the slide deck will be made available to people on the call today. But just in terms of some of the sections we're going to cover, I'll start off with the US elections overview. So what's actually happening with polling? What are the key differences between the two candidates? We'll move from that into a view on just equity markets and sectors. What does the US election mean for some of that? Then a wider lens in terms of global markets, moving from that into forex, the dollar, the rand, very important for South Africans, of course. And then quickly touch on commodities and wrapping it up with what it means for you in South Africa. And again, Sean, I must commend you and the team at IG in terms of including potentially those US indices quite shortly, because it does really broaden the subset that is available for South African traders and investors out there. So quite excited to see that coming on stream. Let's move directly into the US elections. I mean, as we stand today, we are pretty much a week away from what is being described as the most pivotal election globally, certainly in the US. And I remember going back to the first Trump win back then, the pollsters got this notoriously wrong. You know, the polls were all showing you that Hillary Clinton was going to win. And at the last minute, Donald Trump came through very strongly, actually won the election. And so the important point to note here is that it's really a finely balanced election as it stands right now. The early polls showing these two candidates neck and neck together with one another. In fact, the margin between them is within the polling margin for error. So that's telling you it's pretty much a coin flip. And we're going to try and unpack, you know, what does that look like right now? What are some of the impacts? But what it comes down to, what it boils down to is that this is really actually just up to a number of swing states. And I'll explain that to you. Is in the US, it doesn't matter what happens with the popular vote. What happens at a state level is that once a state is won by any particular party, that state's votes in terms of the college of votes, you know, that goes through in terms of determining the national vote count. And so that is why I say this boils down to literally a handful, to around 8 states where this decision comes down to the wire. And those swing states are quite important to watch. It's Arizona, Georgia, Michigan, Nevada, North Carolina, Pennsylvania, and Wisconsin. And again, if you look at each of those individual states, even in those states, the polls are still neck and neck. And that is the reason why I'm saying this is very much a toss-up election. If we look at one more data point here, betting sites, that's been a phenomenon that's come through given the gamification we've seen in markets. And recent trajectory on betting markets has actually seen Donald Trump lurch ahead of Kamala Harris in terms of the race. So pay attention, because that is giving you a data point in terms of social sentiment, certainly in terms of some individuals that are willing to bet on that. Now, I'm going to move from that into the next slide very quickly to tell you that what I want to highlight on this next slide, Sean, is when you look at the panel on the left, that's really an excerpt, and I've included the link at the bottom from the New York Times, and it's effectively the Electoral College vote. It assigns the states that are deemed to have been effectively won by Harris and by Trump, and that's where you're getting Harris slightly in the lead, 225 versus 219 Electoral College votes. And then those states at the bottom, those are the swing states that I actually mentioned to you. And what you can do if you follow that link is you can actually go and drag each of these states into each bucket to see what does that project in terms of the winner. And the point I want to stress here is that it's so finely balanced, because despite the fact that Harris is in the lead, she only needs 45 more Electoral College seats to win, there are multiple pathways in which Donald Trump actually comes out ahead. So that is the point I want to land on here. On the right-hand side, the point I want to land on is, despite a lot of the rhetoric that you're getting in the debates and in the speeches, the issues when you actually go and ask Americans on the ground, what's important to you is, yes, there's lots of talk. We're concerned around China spying on us using their EVs. We're concerned around Huawei. We're concerned around TikTok. But when you break down those issues, look at the right-hand side of that panel, you'll see foreign policy and globalization and trade actually ranks very poorly in terms of what happens to the rank and file American voter. What are American voters interested in? Well, top of the list is inflation. They've gone through this period where the inflation peaked at over 9%. Yes, it's back down to around the 2% handle, but inflation is one of the hotbed issues here. We've also got issues like healthcare, that's quite important. Jobs in the economy, that makes sense. And then the important point is a lot of the social issues like crime, abortion, you know, that coming through in the middle of the pack. So pay attention to which candidates are campaigning and stronger on particular issues. What I have done on this just anecdotally is when a particular candidate seems ahead, for example, the Harris campaign seems ahead in terms of inflation for me. So I put a little blue dot next to that. The yellow dots are where it's still quite mixed. Immigration, that has been really one of the hallmark, let's call it, issues that the Trump campaign has really run hard on. And so I give the red dot there to Trump, for example. But this is just helping you break down some of these bigger issues into what bearing does that have on markets. Now, moving from that into the next slides, and I didn't indicate, Sean, I will take questions at the end of the session. I just want to try and get through the flow. Yeah, Sean, you're welcome to interject. I know you're live on this call with me as well, so you can interject as we go along. But what I've done on this slide, yeah, sorry, go ahead.
Just on that last slide, do Americans not really care about TikTok? Jeez.
So, I mean, it's obviously it's a pressing issue, right? In terms of worried around the social impact that's having. They're worried around China getting their data. But this is very much at the political level. And when you go and you actually poll or you survey people on the ground, it seems as though they're not that interested. They're actually more worried around how far does my dollar go when I go to the grocery store. So that is a research or a survey that's come through from the Cato Institute and New York Times, quite well validated. And again, I think was very interesting for me to see that, because I would have also said, geez, the China, the geopolitical issues, those are important, not factoring that much into the decision-making process. Now, on this slide, what I've got is I've just pulled out the key features. And starting with the economy, if you look at both Harris, and not so much on this slide, on this slide, I'll actually leave as an annex for people. There's a lot to read on that slide, so I don't want to spend too much time on that, but just jumping back to the reading between the lines slide, that's about 2 slides back now. On the economy, both Harris and Trump, if you look at their platforms, both of them signal a massive increase in spending. And so I would argue that both of these will see their fiscal deficit problem get worse over the next 10 years. Now, if we quantify that, Harris's platform shows you around $8 trillion worth of additional spending over the next 10 years. The focus very much there in terms of helping the middle class with, again, handouts, whatever it might be, paid for by higher taxes on the wealthy and on large corporations. Pay attention to this, because large corporations obviously feature very prominently in terms of the index. If you start to see some changes there, you may see some pressure in terms of some of the larger stocks. Trump, on the other hand, $15 trillion worth of additional spending over the next 10 years. That's massive. That's almost twice Harris's platform. Excuse me. And that's very much paid for by what he calls cutting waste and boosting output. Cutting waste, Elon Musk coming through very prominently as a potential contender for a Department of Government Efficiency. I think Musk just wanted that because it spells out Doge, and we know how he likes to play with those kinds of things. But Department of Government Efficiency, Doge, take from it what you will. Both of these candidates are going to spend a lot of money. In fact, if either of them extend the Trump tax cuts, which are up for renewal in January, that's an additional $5 trillion on top of the numbers I've mentioned. And the point I want to land on is the track record is poor. Both of them indicated, or in fact, the last administration indicated pandemic stimulus at $55 billion. They're over $200 billion already. The Inflation Reduction Act, which was a Biden administration signature move, was budgeted at $400 billion. They're now estimating that at over $1 trillion. So the story here is that massive debt in the US means more issuance, means upside pressure on yields, and potentially the dollar over the longer term. And I'll quantify that for you. This all feeds into an inflation story, which I think both candidates, for me, over the longer term, are concerning. And then on climate, Trump will favor fossil fuels, whereas Harris really favoring more of a green platform. If we break it down into themes, last point here, then I will move on. Harris very much coming through with a tech theme, clean energy, industrials and grid infrastructure there, and then home building. And if you look at Trump, there we've got defense coming through strongly, construction, conventional energy, fossil fuels, and financials.
So, Mo, would you say that, when you look at those themes, that maybe both of those, feed a case for commodities or resources? You've got that infrastructure spend, and then you're also looking at construction and, your base metals, your industrial metals?
I think it's a great question, and I'll show you later in the presentation. I am reasonably bullish on resources, on base commodities, simply because of two things. One, on the supply side, investment has been slower. Commodities have gone through a tough time. Mining firms pull back on exploration spend, and so that curtails supply. And then on the demand side, we've gone through this era where infrastructure spend, certainly in the developed world and also in the emerging markets, has been running behind what it needs to run. And so if you put those two together, it leads me to be long-term bullish on the story for commodities. Do we get another commodity super cycle? The jury is out on that one. But I certainly think, certainly on a tactical basis, I would be bullish on commodities. We'll touch on that shortly. Let's move from that into a view on markets and some sensitivities. The slide is titled Sector Sensitivities. It's probably 2 down from this, Sean. If we look at just how markets have performed generally in election years on the right-hand side, you can see as you go into November, December, in election years and non-election years, those tend to be decent months from a seasonality perspective. So for those of you that pay attention to seasonality, sometimes it's the buy the rumor, sell the fact. The markets rally in election years. Look at how strong it is in November, December. And then the big difference. Look at Jan, Feb, March. Once the election is passed, in election years, they don't do that well. And I'll then dovetail this. I don't want to spend too much time. Again, I'll leave this slide. You can break down on some of the micro sector changes. So in healthcare, for example, Trump, for example, would favor the Medicare Advantage carriers. That's more kind of retirees, but bad news for those that focused on lower income. Whereas if you look at Harris, probably bad news for biotech and pharma, but okay for insurers. So there's a lot of detail on the slide. I'm not going to spend too much time on that. I want to move from that into what we've seen in the markets on the next slide, because some of this has started to filter through. Some of it is just based on economically, where are we in the cycle in the US? We've gone through a period where growth was remarkably strong. The US has outperformed pretty much every other global geography. And now we're looking increasingly mature, the debate being, do we go into a recession or do we get a soft landing? That's what the Fed is trying to orchestrate here, a softer landing. Now, as you map that economic cycle against markets, it stands to reason that the market investors will start to position more defensively. And in fact, on reports I've done for some of my institutional clients over the last 2 quarters, I've been saying, let's shift defensively here. That shift came in Q3. If you look at which sectors performed, firstly, real estate, quite strong. That's a story in terms of the Fed initiating rate cuts. So not so much the economic cycle per se, really the rate cycle, but look at utilities. Utilities coming through very strongly in the 3rd quarter, the best performing sector. Excuse me. And so that's telling you that the market is positioning a lot more defensively. You've seen it switch. That's in the top left panel. Now, I move from this into the next slide because the question is where to from here. And this links back to the question, Sean, that you just asked me, is maybe the utilities trade is already behind us. Maybe it continues to run, but there's maybe less juice left in that tank. Some of the defensiveness had already started to come through. But look at resources. Resources was this chronic underperformer. And then again, probably just around the latter part of Q3, starting to see some impetus come through there. So if I were looking at a relative rotation graph on this, I would say pay attention to materials. It's called materials on the S&P 500. That sector on a relative rotation basis does have a lot of potential if it starts to move from the lagging quadrant into the gaining momentum quadrant. That's where I'm certainly looking over the next quarter or 2. Now, from this, we move into just an overall view on the S&P 500, because I must stress, even though you're getting sector rotation, that makes you maybe less bearish on the index as a whole, because instead of just a handful of tech names leading the gains higher, you started to see leadership from other segments of the market. So it means bigger diversification, more breadth of market leadership. But in aggregate, if I look at the S&P 500, this is a technical chart. Sean, I know you like this stuff. I've got an Elliott wave count on this. And both on a short wave and a long wave count, it looks as though we're at the peak of wave 5. And this concerns me because that usually gives way to a corrective phase. It's not a bear market, it's a corrective phase. And you get that in 3 waves to the downside, ABC. Now, why do I highlight this? Is if you look at momentum indicators like the RSI, like the MACD, those have been trending lower. Despite the fact that we've had higher peaks on the S&P 500, those indicators actually have given you lower peaks. And when you see that divergence, that is usually a bearish sign. And also, your traders on this call today, you've got to look at risk reward. If you take that upside projection on a wave 5 to, let's say, call it 6,500 points on the S&P 500, and you superimpose that on a correction, best case at, let's call it around 5,000 index points on the S&P 500, the risk reward starts to look less attractive to the upside. And certainly I would be positioning myself a little bit more defensively here. Pay attention. We may get that correction. Maybe it comes after the election. Remember that seasonality chart that I showed you earlier.
So, Mo, I mean, obviously, in other words, you're saying that the market is looking a little bit frothy, and obviously this is a gauge of the broad economy when you're looking at the S&P 500. So, technical analysis generally always look at trading with a trend, but I suppose it doesn't always mean that you have to be in the market. Hey? So, I mean, would you look at looking at maybe protecting a portfolio by shorting the index, or would you be looking at taking a contrary view, or would you rather, if you're expecting weakness, wait for that weakness to play out and then maybe accumulate at lower levels in line with that longer term trend?
Sean, it's actually an excellent question, right? In that I'm not outright bearish. I think the Fed can orchestrate a softer landing. I don't think we go into a recession. And so I wouldn't be outright short. I think, if you were outright short, you could have called the top in this thousands of points ago, and you would have been wrong. If you want to go short, you want to actually see a sustained move to the downside and a bear trend. And what I want to highlight on that chart is if you look at the long term, the 200-week moving average, we're above that. And for as long as you're above that, you're still in a bull trend. So I would say it really boils down to, are you a long-term investor, are you a trader? For me, in terms of deploying new capital, I'm going to be a little bit more cautious on that basis. If I were a trader, opportunistically, I'd want to actually see additional signs of a correction materializing before actually trying to capitalize on that short. In aggregate, I'm not super bearish. I'm just saying caution is warranted. This has run quite hot. And if you're deploying new capital, maybe just hold off on that a little bit. I'll move from that onto the next slide because it's quite important. And this is a seasonality slide. And what I've done is on the left, it's just basically performance, S&P 500 seasonality, very similar to what I showed you on the election chart. You know, you tend to do okay in November and in December, January, February, March. It's still okay, but a lot less good, if you want to call it that. This is 10 years. You can play around with that data. It changes marginally. But what I want to highlight, and this plays into my hypothesis, is on the right, you've got seasonality of VIX, and that's the volatility for those of you not familiar with that. On VIX, remember, if you see red here, if you see a declining VIX, that's good news. Declining volatility is usually bullish for markets, and you see that in November. In December, you see it tick up a little bit, but not too materially, and then a strong acceleration in January and February. So if I superimpose this on the chart I had earlier with regards to how the markets perform in election years, it plays to my point on caution around the election. It's run hard into the election. Post the election, I would be worried about heightened volatility, certainly in December, and then definitely as we go into January. That's what I'm looking out for, Sean, just on a tactical basis. Now, moving from that into some of the more global issues at play. I'll start off with a chart on China because China's topical, right? We just recently had additional stimulus coming through from China, and it's why this is a very busy slide, but I'll talk you through it. On the left, you've just got the changing mix in the Chinese economy. China is going from being a resources-led, infrastructure-led growth model into more services. Solar has come through very strongly there, and that's what you're seeing on the left. On the right-hand side, though, that's where I want to spend a little bit more time because the market seemed surprised by the China story when the stimulus came through. I've not been a China bear. It's been a painful position to have over the course of the last year until, guess what, hey presto, we get some stimulus and the market rallies, certain names rallying 50% on that news. And why do I say the market shouldn't have been surprised? If you look at the Chinese currency, if you look at their trade surplus, if you look at their FX reserves, as well as their interest rates, all of those indicators show you just how much policy scope China has to still deliver stimulus. In fact, just today, I saw a story about an additional fiscal plan that the Chinese are looking at bringing in early in November. So I'm not a China bear. Yes, it's rallied 50%, but valuations are not demanding in that space. And if we move from that into the MSCI China, the next slide, you can see even with that 50% rally that you've seen off the lows, it was very much in the sideways consolidation. It can consolidate a little bit more, but there's a lot more juice in the tank between where we are right now and the kind of levels we had back in 2020. Certainly pandemic markets were crazy. I'm saying the truth is probably somewhere between where we are now and those peaks. I don't necessarily think we get to those peaks, but I am not bearish on China. I think if you're selective, there is potentially a longer term bull case coming through there. Next slide, we've got, go ahead.
Sorry, can I just say there, I mean, what I find very interesting on that chart there, Mo, is, you know, that amount of volume that supported that rally. And if you want, you know, how excited people get and how quickly that momentum can run. I mean, you know, it's that stimulus, I mean, there's 30% gain in a month supported by a lot of volume. I see that as, you know, technically I see that as quite a bullish signal. You know, if you talk about that consolidation as well, the price is breaking above that Bollinger, you know, it's sort of, it's that momentum to the upside. I think we could actually be, you know, in the beginning of a bit of a trend reversal here, you know, just on the technical there.
I'm so glad that you bring that up. And again, if you look at the technicals, that volume point is so critical because you're right, it rose on rising volumes. Another critical point is it's testing that 200-week moving average. And if it breaks and builds a base there, that becomes remarkably bullish to the upside. So it contributes to why I'm bullish or relatively bullish on China. On the volume point, something important is always look at market positioning as well. And market positioning is why I looked at the sectoral rotation story earlier in the US. Is the market on China is or was caught remarkably short. Lots of institutions that pulled their money. And when it reverses, they've all got to rush back in again. And so that's part of the story you've seen in China. Now, if we move from that into the next slide on India, very quickly, I'll just touch on this.
Sorry, I really don't want to interrupt you too much there, but I just, just on that China move, and we saw how quickly how that reflected at home. When we started looking at our local resource counters, the diversified resources. You saw the likes of BHP and Anglos catching a proper bid, 7% gains in a single day as that announcement. So it is certainly one to watch if you're looking at our local diversified resource counters.
Indeed, and I love tying that back to what does it mean for us, because like I say, I am relatively bullish on resources as well. Part of that is the China story. Part of that is the build-up that we need in terms of infrastructure in the developed markets as well. And yeah, those are all fairly strong. On India, just in the interest of time, very quickly, India's been the standout market. Valuations are very extended. I'm nervous because this could go either way. You could have either had a very short wave 4, which means now you get the wave 5 to the upside, or wave 4 could extend to the downside. So I'm not chasing India. I think valuations look a little bit frothy. I'll move from that into broader emerging markets, because I think this is the way it becomes relevant. And let's tie it back to the US election to a degree as well. Is between Trump and Harris, I would say the market's perception would be that Harris is very much a continuation of what we've seen pretty much from the Biden administration. Shouldn't be bad news for emerging markets. You can see how it's kind of rallied a little bit over the last couple of years. But the Trump administration, certainly with some of the signature moves he's talking about, tariffs, that could hit emerging markets quite hard. It hits the American consumer from an inflation perspective a lot harder. But I would see just on those two, a Trump administration maybe stronger for the dollar, worse for emerging markets. In aggregate, emerging markets, pay attention. You might get a correction. Fundamentally, I think demographics play in emerging markets' favor. And if I'm right on China, that will have a material bearing on the overall EM index. Let's move from that to, excuse me, to the FTSE. And I've been doing a lot of these calls. As you can see, it's US election season, and that's completely destroyed my throat. The FTSE, the UK market, is so important for South Africans because you get the strong correlation between the JSE top 40 and the FTSE. And it's probably been a lot better than Europe. I'll look at Eurostock shortly. But on this, you can see it's kind of consolidated. You are going through that ABC already. It's maybe a little bit more advanced than what you've seen in the US, where you haven't even seen the A leg. And so could the C wave extend a little bit more? Yes, absolutely. On a relative basis, I'd probably be more optimistic on the FTSE than on the S&P, just based on valuations. But more important than that, on the next slide, we've got the Euro stocks. Now, you're going to say to me, you're nuts, Mo. Europe is the chronic disappointment, right? The economy is in the doldrums. They just can't seem to get that right. And I agree, they've got to calibrate their entire growth model. Germany is really struggling. Lots of pressure coming through from China on the automotive side, on the EV side specifically. That's hurt Germany, that's hurt Europe. And Euro stocks is interesting because you're getting some industrial firms, but if you go and have a look at the breakdown, you're also getting luxury goods players. So LVMH, for example, very popular, Louis Vuitton, Moet Hennessy, they're a luxury goods player, but China has such a material bearing. So where you see disappointment on Euro stocks, pay attention to the big market cap companies like LVMH that have actually been hit by China. It's a China story being reflected on another index. You see the same thing with L'Oreal. They had results out, and again, big pressure coming in the beauty segment from China. So pay attention to some of that. Just on the technicals here, on an Elliott wave count, as you can see, if we consolidate here, we could get an extension to the upside. So just relatively speaking, I think there might be some juice in the tank here for the Euro stocks to maybe surprise us and start to come through after being that chronic disappointment. Let's move from that into FX. I'm trying to move quickly. I want to leave some space for Q&A. And the point I want to land on the next slide, Sean, is just the dollar in general. We look at the trade weighted dollar. And the reason I raise this is it's the reserve currency. It's the global reserve currency. This gives the US exorbitant privilege. It means literally they can run deficits of trillions of dollars. All they do is they issue paper out there. And strong global demand for dollars means they can continue writing those blank checks. Now, a lot of people will ask the question, does de-dollarization eventually happen? What about the BRICS currency, right? And I'm saying these trends take 30 to 50 years to play out. Reserve currencies are not immune. At one stage, you had the pound. That was the global reserve currency. You had the Spanish peso. You had the Dutch guilder. So they come and go. And this is the era of the US dollar. And the chart I raise is simply that the US is not without its own interventions. As much as they'll say the Chinese manipulate their currencies and they talk that down just geopolitically, look at the US over multiple decades. And what I've highlighted here is before the gold standard, we went off the gold standard, you see dollar weakness come through. Then you had Volcker, they had lots of inflation, the USD hiked rates so sharply that it led to dollar strength. And eventually the dollar got too strong and they were concerned. So they then went down this thing called the Plaza Accord, where they got the Europeans and themselves to coordinate to actively weaken that dollar. Guess what? It got too weak, so they have another accord. It's called the Louvre Accord, and it helps stabilize the dollar on the chart. And so what I want to highlight here is that the US is not without its own interventions, and where we are right now on a technical basis, yes, the dollar could go stronger. And if Trump wins, you may well see that. You may see that correlate with higher inflation, higher rates, and a higher dollar. If Harris comes through, the dollar might break lower to the downside. So it's on a knife's edge here. Fundamentally, over the super long term, I'm concerned about the dollar simply because they're issuing a lot of debt. That's going to give you fiscal problems. There are other players like China, like the BRICS, trying to erode. And if they get it right, if they can start trading in something other than the US dollar, denominating their commodities, their contracts in that, that is the death blow to the dollar. I think it's premature to have that discussion at this stage. The dollar still remaining the world's reserve currency. Let's move from that to the rand. Very importantly, the rand has done phenomenally well. Again, a busy chart. I'm not going to spend too much time on this, but the rand has outperformed other EM currencies as well as other commodity currencies. And this is because if you look at risk premium on the rand, the lower two panels, that has compressed significantly. I look at the 5-year CDS to gauge this, and that is actually compressed below a long-term, multi-year, longer than a decade average. Even on a higher frequency 12-month rolling average, it's actually compressed below that. So that's telling you lots of optimism priced into the South African, I call it the New Dawn, GNU, Government of National Unity. The litmus test for that will initially start off with just tomorrow. We've got the MTBPS. Pay attention, because National Treasury needs to start delivering on some of those gains. Government needs to start showing that these are sustained gains if you want this compressed risk premium story to persist on the rand. If we quickly look at fair value, I've got some fair value models. One is a financial markets fair value. The rand, interestingly enough, breaking slightly to the stronger side there. It's looking a little bit overvalued on my financial markets fair value on a purchasing power parity basis. This is really just long-term inflation. There, the rand still undervalued. So pay attention to that. My tactical view on the rand is it's very strong. I'm not outright a rand bear. If the government can start to deliver on some of these new dawn gains, that might actually validate where we are right now on a structural basis. But tactically, I'd be concerned with a little bit of asymmetry to the upside. The rand does tend to, they say it takes the elevator when it's on its way up, it takes the stairs down. Just pay attention to that dynamic. I will move from that one very quickly. I'm not going to dwell. The next couple of slides are just more detail on the rand, but let's move to commodities, because I think you asked a question on that. I want to touch on that. Gold is very important. I mean, effectively one of the best performing asset classes. Those of you that have followed me over the last 20 years in my career will know that I've been a gold bull for the longest time. And that is because it offers you great diversification within an overall portfolio. And it did go sideways for a long time as well. And I'll contextualize this. Recently, gold has broken to the upside. It's the safe haven trade. It's the inflation concerns. People like myself with a very long-term view are concerned around inflation in the US just becoming hard-baked based on their fiscal story. And if you look at the technical chart there, it's broken out of this bullish flag. That projects a level close on 3,000. Do we get there? We're pretty close. We're $200 away from that. That's not even 10% from where we are now today. So on that basis, pay attention to gold. My concern here, Sean, is that it is a crowded trade. You needed to be in gold 2 years ago. Now the world's blown up. So I wouldn't be jumping into gold right now. I have a comfortable and fairly sizable position in gold. I'm riding that to the upside. I'll probably keep that as a structural long, as a diversifier in my portfolio over the longer term. But I want to move from this to the next slide on gold.
So if you were, though, looking to accumulate gold into your pullback, what sort of levels would you be looking at where you'd start thinking about buying more gold?
I always like to buy gold. Maybe my wife likes the jewelry. I don't know. But, look,
not talking about her jewelry.
I am financially on gold. If you look at the Elliott wave count there, again, you're looking at the top end of wave 5. I would expect some sort of a wave after 3-wave correction to start to materialize. Where would I, because I've got a sizable position, I'd accumulate anywhere along those pullback levels indicated on the chart. So as soon as you're below 2,500, I start to think it looks attractive again. If I had no position in gold, I'd start taking nibbles around those levels. If it goes lower, you can obviously plow in, but I'd probably stagger my approach there. If you get to 2.5 and below, that's where I'd start to get interested again. I just think we're a bit extended right now. So that's about a 10 to 15% correction, which is a healthy correction in any bull market that looks like this. On the next slide, it's more of a fundamental story on gold. And why I highlight it is, if you denominate your S&P 500 that has done really well, you denominate that position in gold over the longer term. Look at that. Wow, you've actually gone backwards because gold's actually outperformed over that time period. It's the same thing in house prices. So this just talks to the diversification point I was trying to make, Sean, is that gold is a good diversifier. It should never be 100% of your portfolio, but conservatively, a lot of the large investors I talk to, they look at anywhere between 10 to 15%. That's their comfort level. Some people I know go a lot higher than that. But again, 10 to 15 probably gives you adequate diversification. Gold's not the only story though. Let's look at base metals, because this is where it gets interesting. On the next slide, I've got the CRV index, which is both base metals as well as energy that comes through in there as well. And then I've kind of stripped out just copper. And copper is called Dr. Copper, right? But it's the lead indicator in terms of the global economy. You can see how that has kind of rallied hard from the lows that we had kind of pandemic levels. It's now consolidated, lots of volatility, sure, there were concerns around supply chain and so forth. And now it's consolidating. And if we actually break above on this consolidation, that will again be another flag, positive flag, validating a long resources position for me. I am looking at that very closely with CRV. Remember, I said CRV has oil, it's got energy in there, and energy's been the disappointment. So if you actually see that CRV break higher, it could be because oil rallies from where we are right now, or if oil doesn't do anything and the CRV breaks higher, that's even more bullish for the base metals and for the hypothesis around resources in general. This is important because South Africa is still seen as a resources heavy economy, certainly from an exports perspective. If you actually see resources rally, that's good news for exports, tends to be good news for the trade balance, which then tends to be good news for the rand as well. I've touched on oil. Oil's been the surprise factor for me, right? On the next one, and I say surprise factor because if you'd asked me 2 years ago, you'd ask anyone who applied kind of a logical framework to this, the world's on fire, you've got Russia at war with Ukraine, you've got the Middle East with escalating tensions every single day. If you ask me with that kind of construct, what handle would you have on oil? My more bearish estimate would probably have a 90 handle, right? And we're not there. We're struggling to hold 70, we're probably mid-70s today, but we're struggling to hold 70. Now, why has that happened? Is the US has become the world's largest crude oil producer. They're bigger than Saudi Arabia, right? That shale oil revolution really changed the math in the US specifically. So you've got the US, then you've got Saudi, then you've got the Russians. The Russians had occupied the top spot for some time. The US has really just shot the lights out. And so that's additional supply on the market that has depressed prices. You also had the US Strategic Petroleum Reserve selling down, and that has helped keep the prices low. They didn't want the energy spike to hit inflation. Very recently, in fact, today, headlines saying the Strategic Petroleum Reserve starting to put bids back in the market. So I actually like oil. It's not a popular view. I like oil at the moment because I think, yes, Saudi's got scope to boost production, but the US, if the SPR starts increasing their holdings, that might actually give you some upside impetus on price. Certainly as inflation starts to tick lower elsewhere, it gives them some scope to move. And then a Middle East or just global geopolitics, because again, you've got Russia, a hedge there. For me, oil, not looking too demanding. I've got it speculative long on oil right now, and we'll see how that actually resolves. Importantly, on the next slide, very quickly, be careful around correlations on oil. In the shorter term, you can see how that short-term correlation is broken down. And what you're looking at here is oil versus the US dollar trade weighted. That's broken down. The dollar's stronger, oil's weaker. However, over the longer term, pay attention to this. It actually has an inverse correlation. So watch the correlation because it sometimes flicks from positive to negative. And at this stage, you can see just near term kind of correlated, then you get the divergence. That does make fundamental sense. If the dollar is stronger, usually that's bad news for commodities. I'm trying to tie close the circle on my commodity hypothesis. If I'm bullish on commodities, does that make sense that I'm bearish on the dollar? Yes, it does. Because if the dollar is weaker, and I'm talking longer term here, if the dollar is weaker, it stands to reason that commodity prices are higher. They tend to be priced in US dollars. Pay attention. The correlations here have been bouncing around. Now, let's wrap this back up into what does this mean for South Africa. I'm going to pause very briefly for a drink. What does it mean for South Africa? South Africa, on a sectoral basis, on the next slide, you'll see we don't have the same kind of sectoral breakdown that you get in the US. So this relative rotation graph doesn't work as well as it does in the US, where you get a lot more sector differentiation. But what's interesting for me is on a risk reward basis, on a volatility adjusted basis, bonds have been the place you wanted to play rather than South African equities. Even with the rally that you've seen recently, it was a great quarter that came through. Over the last 12 months, bonds have actually done quite well versus equities on a risk-adjusted basis. If you break that down to sectors, property has done well because now you're moving into a rate-cutting cycle. That makes sense. Banks have done well, but pay attention there because there are two elements at play. Higher rates generally help banks, but then hurts them on the credit loss ratios. South African banks have done well. Credit losses haven't ticked up that much. And so the endowment effect will start to erode a little bit as rates start to come down. But we should start to see an uptick in terms of levels of activity. So that's the story on financials. If you look at resources, they've been this laggard. They've really sat in that lagging sector, and you're going to want to see that emerge from that into the gaining momentum. Usually, these sectors rotate in a counterclockwise manner. So I'm looking at resources globally first, and then eventually filtering down into resources in South Africa. Sean, offline, we had an interesting question. You'd asked me about PGMs. So I'll preempt that here, in that my view on PGMs has been more nuanced. I think with the rise of EVs, there's less use of platinum in autocatalytic converters, and so that fundamentally erodes the picture. But if you look at just what happened over the last 2 weeks, you actually had palladium prices, not platinum, palladium prices rally 10%. And look at what that did to your PGM sector on the JSE. It just exploded. So my takeaway there is pay attention to more than the platinum price. You don't get rhodium prices, unfortunately, but pay attention to more than the platinum price when you're contextualizing PGMs as a subsector. I'm going to move on just because I want to get to the Q&A. I want to leave some space, Sean, in terms of, you have a question?
No, I just want to say, just in terms of those resources, you're excluding the gold shares, because obviously gold shares have certainly had a strong momentum this year. I mean, we've seen...
Indeed. So it depends on how you slice and dice it, right? So, I mean, gold has had a great run just based on what's happened with the gold price. And again, leads to a great question. Do you go with gold miners over gold, the resource? And again, those of you that have followed me for 20 years will know I've always preferred the underlying commodity for one reason and one reason only. Remember, I said I wanted for diversification in a long-term portfolio. So that's not a trading view. If you're taking a trading view, then you've got to pay attention to where are we in the cycle, is momentum to the upside, and in that instance, or downside, right? And in that instance, gold miners give you the leveraged effect. So be wary because it works both ways. It works to the upside and it works to the downside. If you see gold prices start to correct, that's going to hurt gold miners a lot harder than it hurts the gold price. And the reason for this is not just the leverage, but they've also got operational costs and eat into them successively over time: inflation, wage bill settlement, electricity. So that's an important distinction.
And would you look at, I mean, are you referring to dollar gold, or would you look at, rand gold? So something like a, new gold ETF, for example.
Yeah. Again, it depends on your investor, Sean. I mean, I think with IG broadening out its ability to trade some of the international indices and so forth, you'd have the ability to play both. Remember, if you're playing rand gold, you're taking two views. You're taking a gold view and you're taking a currency view. If you play dollar gold, it's a pure gold view. And again, depending on how you want to express that, if you're bearish on the rand, if you think we're too compressed on the risk premium story I just gave you earlier, then you're going to want to play this from a rand gold perspective, because you're going to want the gold view as well as the currency view if you're bullish on gold. So depends on your view. I like to separate those decisions for myself. I take a rand view that is distinct from a gold view, and in aggregate, that's how I then execute that in my own kind of portfolio. Wrapping that up very quickly in terms of what does it mean for South Africa. The local story, SA stocks have traded at this massive discount for the longest time until the election. And now that's given you some impetus from an optimism perspective. You've seen a great rally back to where we are right now in terms of the local bourse. Now, valuations are not demanding. Despite that rally you've seen, I call it the re-rating, South African stocks are still way cheaper than a lot of their global peers, whether those are emerging or developed market peers. Does it make sense? Yes, it comes with more risk, but that compression of the risk premium helps South African stocks rally. That valuation is still not too demanding. However, growth has been lacking. I mean, actual underlying economic growth. Yes, I know the JSE is not representative of the South African economy. There are lots of global companies there, but growth in the South African economy has been lacking. You're going to want to see them turn the corner on that. If you want to turn bullish on SA Inc. and SA Inc. stocks, the rest of the index, that's a global story, and that's how I kind of break it down in my head. In terms of, and I'll move from this actually into the next two slides because this really lands the point. The first one you're going to look at is what has the top 40 done for you in Rand terms? And again, very similar to global markets, it's looking a tad overbought. It can rally a little bit further. If I look at stochastics, MACD, RSIs, it's close to overbought territory. In line with my global view, I'd be cautious chasing it at these kind of levels, maybe some brief pullbacks. But the point I want to land on, Sean, which is more important for me, it's probably my last point, and then we can open up for questions, is look at the next slide. And I'll let this land for just a little bit because this is the top 40 in dollar terms. And why I pause here is as a South African investor and trader, you have access to international markets, and certainly now with IG offering that on the platform, that access is enhanced. You have gone sideways since 2018. If you are a buy and hold investor, you are actually just where we are back in 2018. In fact, if I'm really nitpicky, I think it works out to something like a 3% return, which is less than US cash. So on a risk-adjusted basis, for me, certainly, the buy and hold South Africa over the longer term doesn't do you any favors in a world where the Rand tends to depreciate against the US dollar because you've got higher rates and you've got higher inflation. What does make sense is if you're trading this, look at that. That's a great range trading chart. You can actually trade that relatively well within that Bollinger Band. Again, we can unpack that in a little bit more detail. But the nub of the story here for me is if you're in South Africa, don't just limit your investment universe to the top 40. It's remarkably small. You don't get the sectoral diversification that you would get in global markets. I would say play in both pools if you have the ability to do so. There are opportunities in global markets at times that are better than South African opportunities, and that swings around. Certainly the last quarter, South Africa has shot the lights out because you got a return in Rand terms and the Rand has strengthened. But be nimble, have the ability to trade that position if you are a trader, and just pay attention to some of the finer detail. Sean, I think that is my time allotment. I want to leave some space for some Q&A. I'm sure you've got some questions as well.
Great. Okay, so did have some questions coming through. The first question I see is, Mo, it says, RE China. No, I'm just kidding. I'm actually not sure what that means, but so Renee, if you could just clarify that. But next question is, what is your view on JSE with regards to allocation of new capital? Overweight resources and industrials, underweight financials, question mark.
I think it's a great question. And I think underweight financials is always a risky move for one reason only is South African banks are well capitalized. I think if you're going into a declining interest rate environment, the ability for just activity in the market to tick up is strong. So I'd be very cautious on an underweight financials. The resources trade, I must stress, if we strip out the gold story, it's not yet saying, hey, I want to actually go overweight resources right now. I'm waiting for confirmation on global resources indicators, as I've shown you, the CRB, copper, and so forth. Now remember, if you get that, you could see that correlate with some strength in the Rand, which then erodes the attractiveness of South African resource players. Because remember, at the end of the day, the Rand strengthening has a mitigating impact on your basket price in dollar terms, which is actually kind of rallied. Those two offset one another. And all you're then left with is the steady creep in terms of operational costs in South Africa that have been escalating ahead of inflation. So I'm not an outright bull on South African miners However, the diversified miners there, you mentioned BHP, for example, if you can get Rio, global diversified, I like that. So if I were kind of micro allocating there, I would say I'd pay more attention to those global diversifieds versus commodity plays just South Africa specific that might have a lot more pressure on their cost line over a period of time. And then if you look at real estate, that's been a sector that's done very well in South Africa as well as globally over the last quarter. In a declining interest rate environment, that sector does well because they play as bond proxies. So that relative rotation that I showed you, I would say sectors that are kind of gaining momentum that you want to kind of stay in there is you probably still want exposure to that real estate sector. Industrials, yeah, I actually hate that. Hate's a strong word, but I hate that descriptor for the JSE's industrials because it's not a pure industrials play. It's too broad. Getting tech companies in there. It's why I say if you want to execute on sectoral views, for me, the JSE is not the place to really express that strong sectoral, rotation story. I do that more in the global story. That's a very long answer to the question, but I'm saying I'm not yet pulling the trigger on resources in South Africa unless it's global diversified. I'm saying, if you want to ride the gold story, that's a separate story. I like financials. I like probably stocks for now, just because of where we are in the cycle. I think that could still have some juice in the tank. When those migrate from the maintaining momentum into the losing momentum quadrant, at that stage, I would then move underweight that and start to reallocate capital to the other sectors we mentioned.
Great, thanks, Mo. So that other question was broken up. It said RE China. What Renee's asking, I said RE China. With regards to China, is the demographics profile a significantly negative enough that it may offset the stimulus?
Wow, Renee, that's a great question. It's why it broke it up for me, to give me time to catch my breath. China's got an aging demographic, so yes, that is a much longer term story. They've tried so hard to reverse their one-child policy with no success, zero. So they call it the Japanification of China. I think that is a big longer-term risk. The story for me, however, in China is less that than the fact that you've got a sizable enough base of economically active population that any attempts to change the makeup in the Chinese economy away from that resources, infrastructure-led growth model into more of a consumption-led growth model, that still has, I've overused the term, juice in the tank, right? If you look at South African companies that are playing in China, I stand corrected, I think it may be in Sanlam. One of the large South African financial services groups has an exposure to China. And I see that as such a smart play, because as the Chinese economy matures, sectors like financial services will give you a nice underpin for the consumer. The story for me in China was actually the real estate story. So many Chinese people based their wealth and the wealth effect on the property story, and that's kind of come down in a heap. So the government's going to try and support that so that it doesn't collapse anymore, but that's not where they're going to look for the growth. The growth they're going to look for are going to come from services, and that's financial services and other healthcare and so forth. And I think that's enough to offset some of the demographic concerns that over the much longer term would be a concern for me in China. It's why I'm not bearish on China right now, is I think there's enough of a reorientation and reallocation within China to mitigate some of those risks. And the same thing on the industrial side, right? They go from property and resources into this massive build-up. They are the world's leading provider of solar panels and EVs. I mean, build your dreams. Phenomenal story. I had the luxury of visiting their factory in Shenzhen just a couple of years ago. The cars you're seeing now were just concepts that we tested back then, and they blew my mind away. So those kinds of stories in China are a lot more structural in nature. And so China's ability to monetize the global market may be impacted by tariffs, but again, it's not going to be as clear-cut as, hey, the population's aging, we should turn bearish on the Chinese growth story.
Mo, another question here, asking, said you did touch on gold and some commodities, but any comments on iron ore and coal? And it's being asked because if Trump wins next week, would those commodities be beneficiaries, essentially?
So let's break that down firstly to coal. I think coal on a structural long-term basis concerns me. So technically, a Trump win would be beneficial for coal. Yes, if you go back in the slide deck to that sector sensitivity slide, and Sean, you don't have to do it now, but again, people can refer to that. You can see that under a Trump presidency, you would like steel companies. Now, coal feeds into the steel value chain, so it stands to reason coal would help there as well from a furnace perspective. The same for iron ore. So yes, a Trump presidency may tactically give you that uplift. Why I say longer term is the world is transitioning, on coal specifically, the world is actively transitioning towards renewables. Coal, that comes at the cost of coal, because the next kind of base load you'd consider would be nuclear. Germany shut down their plants too early, but nuclear is gaining popularity globally. Tactically, yes, maybe you go with iron ore and coal. Structurally, over the longer term, I'd still be nervous. There are other energy sources rising in prominence that I think can still have some headway. If Harris wins, it's the opposite, right? Because then you've got to be bearish on coal. The iron ore story, there's so much pent-up demand for infrastructure in the developed world. I actually think the infrastructure story has moved from China to the US. Anyone who's gone to the US will know that they've got to build so much more capacity in terms of onshoring, factories, rail infrastructure is creaking and old, roads are terrible. And so the infrastructure story for me in the US is actually, it's supplanted China, and it's why I would be bullish on commodities in general.
Correct. Another quick question here, Mo. I'm sensitive of time. We've got 1 minute here, but asking, does Alibaba have juice in the tank?
Juice in the tank. I like that. Yeah, if I tie that into my hypothesis around not being bearish China, being bullish on services, on the reorientation of the Chinese consumer, then the short answer should be yes. I am a shareholder in stocks like Alibaba and Tencent. I call it a long-suffering shareholder, and now kind of with the rally I've broken even. So I'm hanging on because I think the overall narrative in China is one that I'm constructive on. I would argue, yes, it has juice in the tank, despite the rally that you've seen, but that's very much a very long-term structural view on China, just on how bearish the market got on
China. Okay. This is for your information. I broke even after the struggle. I'm not sure. Yeah, that was just a response.
The person who asked the question is probably like me. You rode this thing for such a long time. You had this high conviction view. Yes, I broke even after the struggle. I struggled for so long. I finally broken even. I'm actually marginally positive, but I'm not in there for that, Sean. I believe longer term, yes, there's juice in China's tank, and that should bode well for stocks like a Tencent, like an Alibaba over the long term.
Right. Right. I am mindful of time, Mo. I think we do have to wrap it up there. Really, really great insights. I'm hoping we can have you back sometime soon, Mo. This is yeah. I think thanks for sharing your time. For the listeners, the guys that have logged in, we will circulate that presentation to you. So we'll send that across via email, so it will be made available. Otherwise, I think let's leave it here.
Yeah, Sean, I think if anyone's looking to find me, the last slide in the slide deck's where you can find me.
Yes. Yeah.
Macrotech, Macrotech's more for the institutions, the brokers like yourself. You will also find me on Magic Markets, which is my podcast with the Finance Ghost. It is a weekly podcast that goes out there. There's fundamental research. If you like fundamental research on global stocks, we do a detailed report every single week in Magic Markets Premium. That is paid for. You'd obviously need to look at that. And then go and find me on LinkedIn as well as on Twitter or X. It's at Mohammed Nalla. Hit me up on there. Ask the questions that you didn't want to ask on Sean's webinar. And Sean, I'd love to come back, because in a quarter's time, I know you're going to want to have me back here to see if some of the views we discussed today actually worked out or not. It's the best way to keep people like myself honest, and I welcome it. So I look forward to it.
That's awesome. I'll hold you to task. But I think you've painted quite a few scenarios here. Can I ask you one last question?
Go for it.
Just before we go, who do you think is going to win?
Yeah, I knew it. I knew you were going with that one, right? It's a great question, and let's wrap up on that. Is that if you asked me this 2 weeks ago when I started preparing the slide deck, I would have said Harris was gaining some momentum. Everything tells me that swung around in the last 2 weeks. If you look at the kind of momentum Trump's gotten on the ground at some of his rallies, based on some of the energy at the Harris rallies, it's why Trump's narrowed that margin. It was like 4 points. It's now down to 1.5. It's 1.4. I checked this morning. 1.4. That's at a nice edge. If you had to hold me to that today, I believe Donald Trump may well find his way into the White House again. And that's not how I was positioned 2 weeks ago.
Yeah.
That has actually changed. It's very fluid. I'm going to watch this very, very closely, but it's why you've got to keep your stop losses very tight. If you positioned a certain way, just realize that because it's a coin flip on the election, that has very different bearings on which sectors will outperform. It doesn't have a different bearing on inflation, I believe, but keep those keep your risk management front of mind. That's the key to success here. It's not getting the election right, Trump or Harris. It's just getting your risk management right.
Yeah, exactly. I think that's a secret to all trading. And I think that's a great note to leave it. Thank you very much for your time. It's much appreciated. Thanks everybody for joining. I think we're going to call it.
Thanks. Cheers.
Awesome. Cheers.